Hey guys, my name's Ravi Sharma and I'm the founder and buyer's agent here at Search Property. Thank you so much for joining me on yet another episode of Search Property TV. If you haven't already, please do subscribe down below. I'm trying to bring as much content, as much value out to you guys with 2 to 3 videos every single week. So be sure to drop a like and also subscribe if you can. I want to introduce to you the Property Wrap. This is where I go through some property articles across the web, some news articles that have been presented that I feel like we need to deconstruct, break down with someone that actually knows what they're talking about in the real estate space and not some just clickbait articles and journalists that like to have some creative writing pieces. I'm going to share my screen. We're going to go through this article about house prices to bounce back in 2021. Let's dive in. So, as the article suggests, house prices to bounce back in 2021 after modest falls during coronavirus pandemic, CBA predicts. Well, this is interesting because CBA also predicted that we were going to drop, apparently, in the worst case scenario of about 30%. So this only got uploaded earlier today, and we're going to come through and we see here, Australia's biggest home lender says house prices fall so far during the pandemic have been surprisingly small. And its internal modelling is predicting a quick rebound everywhere except for Melbourne. Now, I don't know how much I agree with that, especially with Sydney. And we know that it is propped up by, some stimulus being JobKeeper and JobSeeker. I know, it's weird hearing me talk negatively about property. The Commonwealth Bank's economics team initially forecasted an average 10% slide in property prices nationally when the first wave of Australia's coronavirus pandemic was at its peak in April. Okay, so guys, in April, about May time, I actually made a prediction on this channel, so you can check this video out here. It's forecast with full analysis, not just random chit chat on some article that was posted. I actually broke it down in a very conclusive way as to why I predicted what I predicted in that video. So be sure to check that out. Although in a May trading update, the bank revealed that it had run stress tests using the worst case assumption of a 32% price crash. However, with the pandemics currently contained in all states and territories except Victoria, CBA has reduced its base case forecast to an average capital city property price fall of just 6%. We've got some key points here, forecasting a 6% fall in capital city property due to COVID, but the bank warns that Melbourne property values will fall twice as much as the national average. Interesting, okay. New home lending is up almost 12% from a year ago, despite a fall in lending to property investors. Okay, so if new home lending is up, but property investors lending is down, that means we are creating more tax slaves. We have more owner-occupiers, first home buyers running with these grants in the system to go and purchase a lovely property, an Australian dream, which now I think $700,000-800,000 gets you a unit in Sydney. It's a waste of money. So we have this nice fancy graph here. 2009, we've seen what CBA is modeling in the red, and CoreLogic, which is actually what's happened. And they've been fairly accurate. But I think, the argument I have for this is, I think if you look at the trends, yes, they're very similar, but if you get into more of the minute details of how they've predicted things, I don't really see, especially in this sort of area here, and I think they're getting it wrong here as well. But, it'll be interesting. The forecast includes a worse outcome for Melbourne, which is tipped to see a 12% fall in prices from pre-pandemic levels at the beginning of April. The best case scenario happened for all states other than Victoria, where the downside scenario is materialised, CBA's head of Australian economics, Gareth Aird, noted in the report. I actually think Sydney is going to have further correction. I actually don't think prices in Sydney will rebound as fast as they think, but, who am I to say? CBA knows well. CBA is expecting price falls across the country to bottom out during the first few months of 2021. Wow, okay. So the recovery is going to come on a day that actually, we had a setback with the COVID vaccine. So this is very interesting. And a recovery in home values tipped for the second half of 2021. Now, as much as I am bullish on property, you will know on this channel, it's not in the areas that we're most looking at. Mainstream media, this is coming out now saying that, we're looking at Sydney is also going to experience this rebound, which I don't think is going to happen because we've got net migration down. We don't have banks lending to certain investors. I don't really see how we're going to see such a quick rebound, especially in Sydney. However, I am very bullish on regional properties. I'm very bullish on Adelaide and surroundings. And I think what we're seeing is that not all areas will rebound at the same level. We're also now considering, the rest of Australia, the same market, barring obviously Melbourne, which is incorrect because each market has its own sub-markets too. The bank is tipping that home values will rise about 3% from their low point over the second half of next year. Mr. Aird also notes that Sydney and Melbourne had the strongest price gains coming into the pandemic, meaning that price levels in the two cities last month remained nearly 10 and 6% respectively over levels seen a year earlier, despite the COVID recession. Oh, it's interesting. They call it the COVID recession. Guys, I was thinking that the recession was, there was going to be an economic downturn in 2020 or 2021. I started saying this in about September or October of last year based on what the fundamentals look like. But now, obviously, they've thrown it all under this COVID recession, health-induced recession. But in fact, it's, the COVID part's real. But what they've done is they've just thrown everything under the, disguise of it being a health crisis. Outside the two biggest capitals, Mr. Aird is tipping solid price rises for Canberra, Hobart and Adelaide. Hey, there we go, Adelaide. With fairly steady prices for Darwin and only modest falls for Perth and Brisbane. I don't know what's happening in Darwin. I don't think anything happens in Darwin, to be honest. We had always expected Melbourne and Sydney to underperform relative to the national average. The New South Wales and Victorian economies have more exposure to the most heavily impacted services sectors and less exposure to some of the more insulated sectors like mining and agriculture. Now, I'm not a big fan of mining towns, but I am a big fan of agriculture. A lot of the areas that we are currently buying in for clients have strong diversification in the economies, but a large part of it be within the top 3 or top 5 of their sectors in the industry are agriculture. In addition, the Sydney and Melbourne housing markets are more reliant on strong population growth via net overseas migration to underpin demand. Okay, so here we go. We've now said that strong population growth via net overseas migration to underpin demand. How are we going to be in a position to recover when we don't have a vaccine and we've got, ScoMo saying no one can leave the country? How are we going to allow people to sort of migrate into the country when we're not letting anyone in? That does blow my mind. Risks are skewed to the downside. However, while CBA lifted its base case forecast for house prices, it also warned that there is not much upside left in its current forecasts. Okay. Relative to our updated forecast, the risks are skewed to the downside. Any imposition of restrictions would likely see prices fall more than our central scenario, which is based on no further lockdowns and a recovery in national economic activity from Q4. Right, okay. As for why it is forecasting house prices to bottom out not long after unemployment is forecast to near 10%, while hundreds of thousands of home loans customers remain on mortgage repayment deferrals, Mr. Aird tipped his hat to the Reserve Bank. The Reserve Bank, the RBA, has tended to play down the influence of monetary policy decisions on dwelling prices. But we believe that changes in interest rates are the single most important driver of real property prices over the long run. Interesting. I wonder if it still has the same effect when we're at 0.25 and it goes down to 0, which I predict will happen next month. Our message here is very simple. The cost of money impacts all asset markets, including housing. Interesting. Cost of money, value of money, which is falling with inflation. So if you're saving your money, you're just falling behind. We're going to see a massive, massive property boom after this. And, it's not going to be experienced everywhere. It's not going to be uniform, but we are going to see it. And it's because we're going to see asset price inflation. The reason that asset prices, including dwelling prices, can seemingly decouple from the economy comes down to largely one thing: central bank policy and the changes in the cost of money. Brilliant. We finally have someone saying it. Lower mortgage interest rates mean that home buyers, at least the ones who still have a job, can afford to take out bigger loans and bid more for properties they want to buy, pushing up price levels. Interesting. First home buyers drive loan surge. Oh, brilliant. Bring on the tax slaves. Who's going to pay down this debt? These record low mortgage rates have also seen a surge in demand for mortgages, both new loans and refinancing of existing ones. Now, refinancing your existing loans to lower rates just seems smart. New loans, not so sure. While refinancing has dropped back a bit over the past couple of months from a peak in May, CanStar said the level of refinancing is still nearly 40% above the same time last year. And almost $54 billion in home loans have been refinanced between April and July. Our internal data shows that many borrowers are locking in low fixed mortgage rates, observed CBA economist Christina Clifton. Interesting. Low fixed mortgage rates. When we go to zero, that's when I'd be fixing. The ABS data also shows that the value of new loan commitments for housing in July was up nearly 9% from the previous month and almost 12% from a year ago, with first home buyers accounting for almost a third of new home owner-occupied loans. Get the first home buyers in. Now, if you're like age 25, 30, 35, you've just locked yourself into debt trap, prison for 30 years. If you don't know what I mean by that, comment down below. I'll make a video about the debt trap, debt trap, whatever you like to call it. They both end up in the same place. In spite of Melbourne's relapse into lockdown in early July, new housing lending is up, but the closure and hit to consumer confidence may yet result in a downturn in months to come. First home buyers in particular are returning to the market, rewarding government for some of the stimulus being directed their way. Investors are showing little appetite for a strong return to the market, with investment lending down 51% from July last year, and the property market will have to look elsewhere for stimulus. Okay, so we're pretty much saying that investors aren't buying, which, you know, in the main capital cities, probably, and why would you? Vacancy rates are through the roof. You can't find tenants, and if you have tenants existing, they're asking for a rate reduction or rent reduction. However, where we're buying, I've missed out on about 3 properties in the last 2 weeks because someone outbid me. Investors are out there. They're just not in the locations people think they are. This is reflected in Westpac's Consumer Confidence Survey, also out today, which showed that less than 10% of people regarded property as the wisest place for their savings. Okay, interesting. So let's just go through that again. Less than 10% of people regarded property as the wisest place for their savings. Interesting how they write about this, right? Less than 10% of people regarded property as the wisest place to have their savings. Wouldn't that just be 90% of people regarded property as the wisest place for their savings? Everyone's got an agenda here, right? They want to skew certain things to be said a certain way so they can get a certain outcome. But less than 10%, okay, that's crap. That's nothing. The house price expectations reading lifted by almost 22% in September, but still remains 37% below the average level 6 months prior to COVID-19. On balance, people still expect house prices to fall. Oh, okay. Is this the 10% there? Guys, what do you think? You know, I want to know what your thoughts are about the Property Wrap, the new show that I'm bringing out on the channel, where we go through, you know, these articles. Some are clickbait articles, some are written by creative writers, journalists that have no idea about property, probably never owned a property in their lives. They're actually hoping that the market comes down so they can go and buy a property. I think that's what the case is. But I am very bullish on certain types, certain locations. I do disagree with the fact that, you know, CBA is coming out and saying, you know, Sydney's going to rebound. I don't think that's going to happen. I actually think we're going to enter a period of stagflation with property prices in Sydney. Not so much because of a supply and demand only, you know, with net migration, but I think for investors, you really have no incentive to invest in Sydney, because if you're sitting and speculating that house prices will go up, you don't have a tenant in there because vacancy rates are so low. We're also still seeing the supply pipeline full because, you know, they plan that 2 years in advance. So all these units are coming on sale and they're coming onto the market. So I don't really see that, you know, reflection in this article, but I do want to get your thoughts on it. I'd love to start a discussion in our community where we can actually break down some of these articles. And, you know, I'm not interested in just getting a few more views and, you know, creating some dramatic clickbait article titles. I really want to bring some value here. So we want to break down these articles, get some truth behind it by someone who's active, someone who's looking at property probably about 7 to 10 hours a day. And I want to provide you some value. If you guys have enjoyed this, please let me know, and I'll continue doing more of these types of videos along with my whiteboard sessions with my amazing handwriting and also my videos that I've been presenting so far. If you guys have liked this, smash the like button. Also hit subscribe if you haven't already, and check out my other videos. I'm here to educate. I don't have an agenda. I really genuinely do care about people getting educated in this space, and that's why I'm putting in this effort. I'll catch you guys in the next video.